Good morning. Welcome to the morning market briefing. Today is Tuesday, June 23rd, 2026. I hope you are doing well. It's going to be a very interesting day today. We do have some reversal of the AI narratives going on this morning, so we'll talk a little bit about that. I also want to talk a little bit about what the underlying growth in the economy is doing and how we're thinking about that. It's interesting to me, Tom, too, and I want to discuss a little bit more on this, is why interest rates are not going down, even though oil is coming down fairly rapidly. So I want to talk all about all of these dynamics that are going on. I think we'll start off with just Oracle. Oracle came out with its 10K. They have a different filing period. Their fiscal year ends midway through the calendar year. So we just got news that they reduced its workforce. That Oracle reduced its workforce by 21,000 employees over the last year, from taking it down from 162,000 to 141,000. These are not new job cuts, but this is the first time we've had a definitive number on them. And it's more than expected. And I think this is something that we've seen at big businesses, which is one of the reasons that we think that some of these job data that we've had over the past couple months have been kind of fake. So I don't know if you have any comments on that.
I mean, it's just one of the many reasons. I would say the biggest reason is that we know that all the ones from the last 5 years were fake. And so, fool me once, shame on me. Fool me twice, shame on you. Well, the other way around. Either way, it's not looking good out there.
Won't get fooled again.
There's no, there's just been no evidence to me that there's a firm labor market. I mean, if we look at the layoffs.fyi, which we have been referencing since the beginning of COVID, I mean, we've had the biggest 2 months in March and May since we've had, really going back all the way to the pandemic. And that's, this is a tech-specific layoff area, but I mean, it's just huge numbers in the hottest market, or I guess the hottest sector in the world. How is it possible that we're seeing net job gains? I just don't see it.
Yep. And across the seas and across the Pacific, we're seeing, again, tremendous volatility in Korea. The Korean stock market was halted again for 20 minutes overnight. The stock market was down 10% overall. SK Hynix and Samsung were each down more than 12%. This is a combination of forced liquidation. A lot of money has been put into either overtly on leverage, betting on these companies, but also on levered ETFs. And I think that that's something that we haven't talked a lot about on this podcast, but it's something that's definitely taken hold, especially of retail traders. And as things start to turn, the liquidations in those funds are rapid, and they're forced liquidations. And Korea is a very, very, very concentrated market now in SK Hynix and Samsung, basically memory chips. That's all the Korean economy is, as measured by the stock market. And they're seeing the volatility as a result. And we saw that bleed over into the futures this morning. I think one thing that I wanted to spend a little time on today, and Hicks, maybe we can pull up this chart now. This is Ramp AI. So this is free data. You can go onto Ramp AI. I think it's .com. But they'll give you a fairly good estimate of how quickly AI adoption is happening across corporate America. And what we've seen is OpenAI is kind of plateaued, but Anthropic on a year-to-date basis has really accelerated growth. What you've seen in the last couple of months is that growth has started to taper off. And we haven't seen another model really ramp. We haven't seen Google ramp, XAI, DeepSeek. And if you look at the overall global adoption of AI, we've gone from 47 to 49.1 in February, 51.3. So a couple monthly jumps of over 2 percentage points, to 53 in April, a little bit of deceleration, and then just 54.2 in May. So continuing to drive adoption, but at a slower rate. And I think this is very interesting when it's coming at the same time that CapEx is accelerating. So at the same time that people are really investing even more aggressively in AI, Google issuing stock for AI, and uh, OpenAI and Anthropic potentially coming public, Microsoft increasing capex, Meta increasing capex, Oracle increasing capex. At the same time all this is going on, we're actually seeing that growth curve in AI adoption begin to plateau, at least for the time being, which is very interesting to me. And I do wonder if we get into Q2 reporting season, if the demand signals from AI are going to be as strong as they were in Q1. And I think that that's a question that the management teams are going to really grapple with, the messaging on that as we get into mid-July, late July, when these companies report earnings, Tom.
I mean, I think it's clear that we've reached sort of the critical mass here. I mean, think about like the early adoption of cell phones. If you would go get a cell phone, you used to have to pay $500 for a Nokia block phone. Now the market is so saturated that, you watch these commercials, they're like, hey, we'll give you 2 free iPhones, a free subscription to HBO Max, and we'll wash your car if you come join Verizon. Because at a certain point, the number of people who are going to be using this reaches such a high level that each incremental new user, you've got to incentivize them to join. And I think that's where we are. I think the people who can use AI are going to use it and are using it, but the number of people who are going to continue to add is going to slow at a tremendous rate. I mean, and I think that it doesn't bode well for companies like, Google or Meta, who have suddenly said, hey, we're going to spend $1 trillion between the two of us over the next 2 years to build this out, because, the incremental possibility for return on invested capital starts to diminish very quickly. And so I think that's where we are. I mean, I had a client ask me that the other day, as part of their equity raise, Google put out these convertible notes where it's like a 6 1/4 coupon, and they convert to Google stock if Google goes up to, I can't even remember what the name of or what the number is for the conversion price, but it's like, man, you get Google stock and a 6% coupon, and they were trading above par, even though they weren't anywhere near the conversion price. And my thought is, like, these are really interesting. Now is not the time to buy them, because if we see a slowdown in compute demand and suddenly Google takes a 20% bath, you're going to be able to buy these at a 9, 10, 12% yield and have exposure to Google stock. So if it recovers and you get functional, you buy it at 80 cents on the dollar and at 6 1/4, you're going to be getting a double-digit return on your coupon based on your price. Then you get the price action. That's awesome. But if you buy them now, you're basically looking into following Google down plus getting 6 1/4, and you aren't really if they dilute the stock more, or they spend too much on capex and issue more debt, like, you end up in a worse position, because when you're in those hybrid securities, you have the worst of both worlds. You don't have any claim on the debt. You don't have any claim on the equity. You just have this in-between spot, which is why they really only work for banks, because if a bank gets wiped out, you don't get anything anyway. So, but I just think, yeah, sure, interesting. Certainly an interesting place to be, but let's wait, because things are starting to crack.
And we're going to be talking a lot about this. So the question, of course, becomes, so what are you guys doing about this? Well, we're actually going to be going right from this conversation into a meeting to determine that. I know for a few clients who are approaching retirement or in the early days of retirement, we are in the process of, or have already reduced some of the equity allocations and increased the fixed income allocations, because one, that's something that we want to do strategically, which is how we make asset allocation decisions anyway. And then secondarily, if we're already going to do this, now is as good a time as any, with equity markets still pretty much at all-time highs and fixed income markets yielding as much as they have in the last 20 years. So it's a really good time to make a shift that you were going to make anyway strategically. Now is a great time to do it.
Yeah, I mean, the listeners of this podcast will know we've been talking about this all year. This market is a little too hot. I'm a little bit worried about it. As this thing rises, we're selling and buying bonds, selling and buying bonds. And bonds are functionally flat today. So, all those things we either sold yesterday or sold 2 weeks ago are in a better spot now, because we sold them at higher prices. And now, you're getting in the position where you're swinging back the other way. If you're in a 50-50 portfolio, after today, you'll probably be 48-52 in favor of bonds. Well, we've got a huge position in Las Vegas Sands corporates that matures today across 70, 80 accounts. That's a great way to not have to sell anything. The bond turned to cash. We're going to buy some equities with that money, and we're going to buy them. Looking at futures, depending on if you're looking at the Dow or the Nasdaq, somewhere between 50 basis points and 250 basis points lower than yesterday. And that's the natural flow of bonds. And that's why we do it, was why we stick to an IPS, why portfolio management is not we put you in a model and we never do anything, and in 6 months we rebalance. It's like we need to be rebalancing in real time, all the time. And it's labor intensive, but I mean, that's the name of the game, and it protects portfolios.
Let's shift gears to underlying growth. Eurozone, we had some relatively soft PMIs, purchasing manager indices today, especially on the manufacturing side, decelerated. Services continue to be in recession in Europe. In the UK, things are quite negative. I think we're starting to see why Keir Starmer is getting forced out. Services fell to 48.7, so they're in contraction, and manufacturing fell to 53.1 from 53.9. Both of those were below expectations. So I think, Europe's telling a story that growth is slowing. Sunbelt reported earnings for the quarter ended in April, so it took a little while to get their act together, but this is obviously the equipment rental company. I think we have a chart on this too, Hicks. We saw really robust acceleration into Q4, which again is the April quarter. And they gave very strong guidance above street expectations for the next fiscal year, which ends next April. So things have been good in the U.S. And the question just becomes, is this sustainable? And I think to an extent, a lot of these projects that are going in the ground now and that have already started. But I do think that there was a little bit of a pull forward ahead of the World Cup. I think there'll be a little bit of a hangover after the World Cup and into the midterms. And I think that, things are not linear. Progress is not a straight line. And whether we're talking about AI or whether we're talking about underlying economic growth in the United States, these things just do not move always, 1% a month. That's not how life works. That's not how the markets work. That's not how the economy works. And I think that most people appreciate that, but it's difficult to appreciate it. I mean, it's easy to talk about now, but and I'm not saying this is the expectation, but if we're here in a couple months and the market's in a very different place, I guarantee you it's going to be a lot tougher to remember that progress doesn't happen in a straight line. And so I just encourage everyone to remember this conversation and know that, look, this could happen. That doesn't mean that we're not making progress. It just means that that it's bumpy, and that's what happens in life and markets and the economy. It's bumpy.
Yeah, I mean it's human behavior, right?
Mm-hmm.
You look back at history, it's like, oh, what caused World War I? Somebody shot the Archduke Ferdinand. Like, that's how you learn it in school, but it's like they're, not 7 billion inputs, but it's called at the time 4 billion inputs. And all of those things were a confluence of events to lead to World War I. But when you look back, that was just, they shot Archduke Ferdinand, and that's how people think about markets too. They'll be like, oh, what caused the markets to fall? Well, it was COVID. And it's like, well, there's also the Morgan Stanley report that said that GDP was going to fall by 40%. And there was that, I forget the study that came out that said everyone was going to die. There are all these different things that went into it, but everyone was like, COVID, and that was that. But it was a lot of errors all simultaneously led to the market crashing for 3 weeks.
And when the market crashes like that, people are not speculating that things are going to be bad. They know,
and they extrapolate it out for years.
Yes.
Yeah.
Exactly. Do we have? Are you on Bloomberg?
No, I'm not.
Okay.
For those in the know, my Bloomberg machine burned up, so we put it on a laptop, and I failed to open the laptop this morning before walking in here.
For the viewers, I've been on my phone trying to frantically refresh and get the Richmond Fed Index to get a more up-to-date gauge on what's going on in the economy, and I cannot. The page is not refreshing. I don't know if I'm way off on the timing. I could have sworn it came out at 8:30. I checked Twitter. Nothing. So we'll update you on the Richmond Fed Index tomorrow, but Tom and I are going to get to that meeting, discuss the implications for investment portfolios. If you have any questions, please let us know. Until tomorrow, we'll see you then. Bye.